I want to acknowledge you for taking the time to educate and empower yourself on the topic we're covering today of life insurance as an asset class. In this discussion, we're going to talk about permanent life insurance. We're going to cover the advantages and the disadvantages of permanent life insurance. We will also discuss term life insurance. This is insurance that's going to pay you a benefit in the event that you have a death within the specified term defined by the policy when you purchase it. My request as you go through this video is that you take diligent notes and you write down the things that you're aligning with or things that you're not understanding or that you're not aligning with, and you write down the questions that you have so that you can have full confidence in whatever the final strategy is that you choose. The questions to ask yourself when it comes to life insurance is, what do I want to do to make sure that my family has everything that I would want them to have, even in the event of an untimely death? What are the possibilities and how could life insurance be used to actually increase the amount of cash flow that I have now and in retirement? What are the possibilities of using my life insurance to help me with my wealth accumulation? What are the options available in the world of life insurance that, if used properly, could help give me optimal results combined with everything else that I'm doing in my financial world? Look inside of those questions to create a possible future where you've got confidence in the choices you make in the space of life insurance and investing for that matter. So since term life insurance is pretty simple, it's kind of like car insurance. You don't wreck the car, it doesn't pay. Well, if you don't die within a time frame, term life insurance doesn't pay your family. But that's a good thing because that means you are alive. But let's look at it this way. So here we've got the x-axis, which is the length of time that you buy a policy for. Then we've got the y-axis, which is the death benefit. For instance, if you have $1 million of death benefit and you purchase a 10-year plan, it will last 10 years and then the death benefit is gone and it goes to zero. Well, you could also purchase a plan that protected your family for 15, 20, 25, 30 years. The premium will continue to increase the longer the protection time is, because the facts are you're more likely to die in a longer time frame than you would be likely to die in a shorter time frame. Therefore, the insurance company charges more. And this works great to get low-cost coverage. So how are the rates determined for term life insurance? Well, they're going to look at what your age is, the length of time that you are protecting, the amount of death benefit that you're purchasing, and what your current health is, which is why it's important to lock this in, because we don't normally get healthier as we get older. The advantage of term life insurance is it's inexpensive. The disadvantage is that it is going to run out in a term of time, and most studies show that less than 1 or 2% of term life insurance pays, so it's probably just going to be a cost factor. However, in the event that it's not, you want to make sure your family is protected. And because it's so inexpensive, everyone, in our opinion, should have an optimal amount to protect their family based upon the income that you make. What do I mean by that? Well, what you do is you can take a look at the income that you bring to your family and say, of my income that I bring in, how much of that do I want to be there in the event that I was gone for my family to still achieve the goals and the dreams that I wanted them to have prior to my untimely death? That's the question at hand. Well, how do you determine that? One way is you can use what we call the 5% rule. So what that means is that you take the amount of death benefit that you have, and if you took 5% of that number, that's the income that it would provide your family for the rest of their lives. For instance, if you had $1 million of death benefit, you passed away, your family gets the $1 million, they invest it in a portfolio of stocks, bonds, and mutual funds or real estate, whatever they decide, and then let's say they took 5% of that every year. Then it would replace $50,000 of your income. So if your income was $100,000, well, then you'd be replacing half of what you were bringing to the family while you were alive. Maybe you get $2 million. Well, then it would replace, in that example, all of the income that you had while you're alive. So you've got to look at your income and the amount of your income that you would like to protect. So step number one in the process of Looking at life insurance is figuring out the right amount that you should have for your family, because we know that we could at least get that amount in term life insurance to get the appropriate protection. Now, if cash flow is there, you may also want to use permanent life insurance to go along with the term and life insurance, because there's some additional benefits that would come from that, because permanent life insurance is permanent. It doesn't ever run out. So how does permanent life insurance work? Well, that's long-term life insurance. It is permanent. It is going to be for the rest of your life, unlike the term that was for a term of time that you had a death benefit, went out and dropped off. You can see here the death benefit starts at $1 million and it just keeps going up until you inevitably pass away. There's also another element, though, with permanent life insurance. You'll see there's a cash value portion of the policy. So you've got the cash value and you've got a death benefit, and that cash value, as you can see, also just continues to grow throughout your life. So the question is, how do you find the right balance? Should you get term insurance? Should you get permanent insurance? Or should you get a combination of both? We'll work with you to determine what the best course of action is to meet your financial goals. I want to speak a little bit to permanent life insurance, and most specifically, I want to speak to a type called whole life insurance. When you go on Google and you Google whole life insurance, you're going to find all kinds of information that's out there. You're going to find some people that hate whole life insurance, and you're going to find some people that think whole life insurance is the greatest thing and you should put all of your money in it. Well, the question is, what's the right answer? I always tell people, if you follow the money, you're probably going to find that people that don't like whole life insurance are in the business of just investing and doing assets under management, and people that say you should put all of your money in whole life insurance are just in the insurance business. The reality, like most things with life, is there is an appropriate balance. So the key is to understand clearly what are the advantages and the disadvantages. Now, I will tell you, as a certified financial planner, one of the things I had to do was take 6 exams before I sat for my final exam. Of those 6, one of them was just on life insurance. So I have a vast knowledge and understanding of how life insurance works. And I will also tell you that most of the negative stuff that you can read about whole life insurance, I actually tend to agree with, because it's true in the context of what some of the disadvantages actually are. However, with that being said, the reality is if you structure it the right way in the context of your specific fact pattern and financial plan, you can actually eliminate anything negative that you could ever read about it, except for one, and that is there is an upfront acquisition cost to getting the insurance. So the question you have to ask yourself is that acquisition cost of getting the insurance worth it? Because you're going to get that back in spades on the back end, and I'll explain what I mean by that. So are you more interested in what something is going to do for you right now today, or are you more interested in the impact that it can have on benefiting your long-term financial plan? That's really the question. So I always say it's kind of the hard easy. With some things in life, and I would even argue with most things in life, doing the hard thing first is better, because then it gets easy, versus only dealing with what's better for you right now today, which is easy, then it normally gets harder later. I'll give you an example. Let's look at a mortgage, okay? If you went out and you purchased a home, let's just say you bought a $500,000 home. Well, you're going to have a mortgage on that home, and let's just say hypothetically that was around $3,500 a month, and then you've got to pay your property taxes. Let's say hypothetically that was $500 a month, so you're paying $4,000 a month, or $48,000 a year. Have you ever looked at how much equity you have in your home after 1 year? If you look at the numbers, what you will realize is it's almost nothing. It's barely any equity. So what ended up occurring is you had a high upfront acquisition cost. It wasn't a good deal today if you were selling your home within 1 year. Most people would agree, though, buying a home is a good thing. And in the long run, there's an advantage to owning your home versus renting. And that's the difference between term insurance as renting, Permanent insurance is buying the home in the analogy that I'm putting forth. The point is that both have an upfront acquisition cost and both have a long-term benefit. It's the hard work first and then it gets easy instead of vice versa. So let's go back to our graph and get an understanding of what we've got here. So this is, by the way, just a total hypothetical. It's going to be very different based on your age and your health and all the factors that I talked about earlier. So you've got to actually look at this for your personal life. I'm just trying to explain a concept here. So you might have a death benefit starting at $1 million, and over 30 years, let's say it grew to $1.5 million. Let's say that you have a cash value. It starts at 0, and over the 30 years, you're putting, say, $12,000 a year in hypothetically, and it grew to $750,000 of cash value. This is just so that you can see the components. Why does this work, and what are the benefits of utilizing whole life insurance so that you can have this work as an asset class, to work as a fixed income portion of your overall portfolio? And I do want to mention there are a couple of other types of life insurance that you should be aware of. There's also what's called variable life insurance, and there's indexed universal life insurance. The reason I'm not speaking to those because those are appropriate for certain circumstances, but the reality is those have variable costs associated with them, and the rate of return or the rate of credit that those policies get is based to some degree upon how the stock market performs or stock market indices. And the reason I'm not discussing that in this conversation is because whole life insurance is a fixed income vehicle as compared to something being based upon the stock market. So just want to give some clarity around why we're not discussing those so that you understand the space of which we're speaking to for this particular asset class. There's also universal life policies, which also have variable costs, and those are very appropriate many times in the world of estate planning that I'm not discussing here. So what is the benefit of using whole life insurance as a fixed income vehicle? Well, I want to show you 10 key benefits that you would receive by owning permanent life insurance in the form of whole life insurance. Well, number one, the death benefit is income tax free, meaning upon your death, whatever that death benefit is, it will be payable income tax free. Now, that's not just for whole life insurance, that's life insurance as a whole, and that's a good benefit for your family. Benefit number two, the cash value grows income tax deferred. So the money on the graph that I showed, putting $12,000 a year and it grew to $750,000 hypothetically, you never received a 1099 each and every year and had to pay tax on that growth, like you would if you had it in some type of brokerage account that maybe you had a bond portfolio, stock portfolio, mutual fund, whatever it was. You wouldn't have to pay tax as it grows. And you get to take the money out that you put in tax-free, and as long as you withdraw money through policy loans, you can continue to take out even the gains on a tax-free basis. Now, that's income tax-free. That doesn't mean it's cost-free, because when you borrow against a policy, there will be some cost associated with that. But the tax play there is that the cost of borrowing is going to be less than what income taxes are, and so that would be based upon your particular situation. But there is a way to generate tax-free income from the cash value of these policies, without a doubt. Benefit number three, the cash value is protected against lawsuits and creditors. Now, this is specific to the state that you're in, so we'd be happy to look at the state that you reside in to make sure that this is applicable and to what extent that it is. Number four, the cash value is protected against the effects of illness and injury. In other words, if you get sick or hurt or disabled according to the terms of the contract, it'll waive your premium. So in the example we were talking about earlier, the $12,000 a year that you were putting into the policy, if you were sick or hurt and couldn't work, then it would take care of that. The policy is designed so that whatever happens, you've got protection. Obviously, if you were to pass away, your family's protected. If you got sued, depending on the state you're in, you could have the cash value is protected. If you got sick or hurt, you've got protection against that. Or if none of those things happen, then you've just got your cash value build up from you putting your premiums into the policy over your lifetime. Number five, Mutual life insurance companies. With whole life insurance, if you purchase it through a mutual life insurance company, well, then you become part owner of the company. A mutual life insurance company operates on behalf of its policyholders. That is an option that you have available to you. Benefit number 6, you receive dividends and growth. That's why I showed you earlier in our hypothetical that you saw the cash value just growing over time. Interest and dividends are being paid on that. You have growth. Number 7, the life insurance functions as an asset class as part of your overall fixed income portfolio. So to the extent that you're not going to put 100% of your money in equities, whole life insurance will function as part of your fixed income. A great benefit. Number 8 is the financial strength of a life insurance company. It's important to look at the company ratings because everything that you purchase in a whole life insurance is being backed by the financial strength of the company that you choose. So if you choose a great company, then you have that strength that is backing everything that you're doing. And that gives a lot of safety and certainty to you as a purchaser of a whole life insurance policy. Number 9, you no longer have to do cash hoarding. Many times people have a lot of cash because they want to have a war chest of money that they can access for whether it's an emergency that shows up or it could be an opportunity, a business opportunity, a real estate opportunity, whatever shows up that you're interested in. By having the cash value in the policy, you have access to that cash value in many different ways, through withdrawals or through loans. So it becomes part of that war chest along with your cash, but now you're also getting the interest and dividends and growth that we spoke to earlier on that money, and it's part of your fixed income. And the last benefit, which is benefit number 10, in my opinion, is very significant. The death benefit becomes an accounts receivable. What do we mean by that? To explain, I want you to put aside life insurance for a second, and let's just talk about investing. You're investing your money and you're working your way towards retirement. And you get there, and for the sake of our example, I'll just say per $1 million of investments that you have at retirement. Pretend like you have no life insurance. You just bought the term insurance, you invested your money, and now per million that you have in retirement. There is what's called the safe withdrawal rate. So if you look up, there's different studies that show there's a certain amount of money you can pull from your portfolio if you don't ever want to worry about running out of money. What's that rate? Depending on the study you look, it might be 2% or 3% if you're more conservative. If you're feeling a little more aggressive, you might say it's 4 or 5% of your portfolio that you can withdraw if you intend for your portfolio to continue to grow so that your spending can keep up with inflation even when you're no longer earning an income. That's what the safe withdrawal rate is. So here's what shows up for most people. Now they're retired, they're not making an income, they've got this money that they've built up, and we're saying per million. Well, it'd be easy to say spend your money, right? You want to die with $1 left in your account and then you spend it all. Nobody does that. Why? Well, they have what's called retirement anxiety. Every million you have not only has to last for the rest of your life, it has to last for the rest of your spouse's life. It has to be there for church, charities, children. Because it has to be there for all those things, most people don't spend much of it. So in that withdrawal rate, it might be, let's say 4%. $1 million at 4%, that's $40,000 a year. So when you think of $1 million, that sounds like a big number, and $40,000 doesn't sound like so much. But that's the reality of what people are spending. However, what if you had permanent life insurance? And in the example that we looked at earlier, you knew you also had $1 million death benefit that was guaranteed to be paid, come into your world at some point in time. Do you think that would impact your ability to spend and enjoy your other $1 million? We see it happen all the time. People are more comfortable, even if they're depleting some of their capital, spending maybe 5, 6, 7%. It could be you're spending $50,000, $60,000, $70,000. Now, that might deplete your capital over time, but what's guaranteed? Eventually, when you pass, the money comes back in, it's there for your spouse, church, charities, children, whatever it is that you desire. And that's the power of the death benefit and what it provides for you as a living benefit, especially early in retirement when you can still go. That's what's awesome about permanent life insurance that gets missed so many times, that it frees you up and gives you a permission slip, if you will, to spend and enjoy the money that you've accumulated. So you see, life insurance, term and permanent, should be part of an overall financial plan and strategy, and then you can benefit from the accumulation and the increase on the death benefit and on the cash value, and give the protection you want for your family. And that is the advantages as well as the disadvantages of permanent life insurance.